Daily TV Profit, 7 to 7:30 is when we bring to you a complete roundup of the top global developments. And contrary to what we have been talking about in the last couple of days, there's bad news to report, I'm afraid, and both in terms of equity market cues and global economic data-wise. But let's headline the top stories for you first. The Dow has dropped more than 200 points on Tuesday, handing Wall Street its worst day in 3 months on weaker cues coming in from across the world, and China's slowdown is hitting global sentiment. Europe's economy has contracted in the fourth quarter as investment declined by the most since 2009, and exports and consumer spending has dropped. Gross domestic product shrank 0.3% in the Eurozone. Oil prices dropped to a 2-week low on increasing US crude stockpiles, and as the European Union offered to resume talks with Iran over its nuclear program. Gold prices have dropped 2% as investors continue to worry about a possible Greek default. And here's where analysis and perspective will come in from this morning. For a complete health check on the global economies and on equity markets, joining in shortly will be Seth Freeman, CEO of EM Capital Management, and Dominic Bunning, Associate Forex Strategist with HSBC, will be joining in from Singapore to speak to us shortly to help us read into the currency market cues as commodity currencies and the euro get hit on the back of weak cues coming in from across the world. First off, let's look at the Asian market cues that are coming in this morning, and we have across the board a sellout right now in the markets. There is a sea of red out there. We're looking at the Japanese benchmark index Nikkei right now trending downwards, and you have the Hong Kong market looking weak as well. In fact, the MSCI's all-country world index has dropped more than 2%, the biggest one-day drop that we've seen since late November. And across the board, we're seeing a lot of activity coming in right now. Selling activity mostly. Move on then and take a check of what's happening with US stock markets, which have slumped, giving the Standard & Poor's 500 index the biggest decline this year. The Dow has dropped more than 200 points on Tuesday on renewed fears of a disorderly default in Greece and concerns that China's slowdown would perhaps hit global growth. On the screen are the closing figures for the US markets for you. About 10 stocks fell for every one that rose on in the New York Stock Exchange, with banks and mining stocks being among the top decliners. Now, 29 out of the Dow's 30 stocks, they've retreated on Tuesday, led by companies whose earnings are most closely tied to economic growth. So companies like Alcoa, the largest US aluminium producer, dropped 4%. Caterpillar, which is the world's biggest maker of mining and construction equipment, it lost about 4% as well. Then financial companies, they were the biggest draggers on Wall Street. Bank of America retreating 3.3%. Look at the other banks like Merrill Lynch, etc. All of them dropping anywhere between 3 and 5%. Wall Street's anxiety gauge, which is the CBOE Volatility Index, or VIX, that has jumped up 16% on Tuesday to close at 21. That's above the 50-day moving average. For the first time, we've seen that kind of move since November last year. That's what has happened. Now, why has that happened? We'll get you more perspective going in shortly with Seth Freeman joining in as well. But one, there's concern growing about Greece going in, perhaps, the success of the Greek debt swap deal, and of course, two, the European economy contracting in the third quarter. So all of those details are making the markets slightly edgy at this point in time. European markets, a quick check of those markets, and you'll see that Europe has contracted as well. What we're seeing across European markets, shares, they have dived to 1-month closing lows on Tuesday, ending an almost 3-month rally as investors sort of cashed in on the profits after new concern surfaced that Greece would perhaps go ahead and default. We're also seeing lots of comments coming in there from Greece, wherein we've seen the Greek finance minister saying that the country is ready right now to activate CSEs or collective action clauses, which outright literally means that the country would default. You've got the Germany's index DAX and the French CAC 40 dropping 3.4% and 3.3% respectively, and you've got UK's FTSE 100 ending down 2%. Let's get some perspective going on what's really happened, because lots of analysts that we've been speaking to, they've been talking about how Tuesday's correction was sort of necessary to be able to make up new opportunities for buying. Joining in right now for a quick chat on the phone line is Seth Freeman, CEO of EM Capital Management. Seth is joining in from New York. Seth, good morning here from India. This is Bianca. It's been a while since we spoke. Seth, there's been a lot of concern, and analysts have been talking about a pullback for weeks, but perhaps, do you think this 200-point drop on the Dow that was a bit overdone as far as the fear and anxiety gauge goes, or do you think this was perhaps something that was in the making any which way?
Well, I think it's been in the making in the sense that the idea of extend and pretend eventually reaches its ending point. As I've been discussing with your viewers, the Greece situation has been dragging on for so long, and time is the enemy in this sort of situation. And I think that what's happening is everyone's now realizing that this is not a restructuring. This is a default, no matter what you want to call it.
Seth, I'm just going to come back to the U.S. markets. Despite this fall or this correction, as we may call it, that we've seen on Wall Street on Tuesday, the S&P 500 is still up about 7% for the year. And if we also take the fourth quarter gains, and if we include that, then the S&P is still up about 20% since September 30.
Mm-hmm. Well, I wouldn't make a lot out of today's drop until we see if this is really a trend. It seems like a large number, but 1.5%, 2% is not a disaster. So I think we need to see unemployment and employment claims. That might give us a better read on how the U.S. market will react.
There's a glut of bad news out there, and it's never so good to start the day as we are here, starting the day with bad news. But give us a sense of how long do you think this equities sort of glut will continue? Because we've got a whole host of bad data. We've got China cutting its growth outlook. We've got weak GDP figures from Eurozone. Brazil as well, with its GDP expanding by a meager 2.7% in 2011. How long will the markets remember this?
Oh, I think, as we've seen in the last 2 months, the market is looking for good news wherever it can find it. What I was reading today about the situation in Australia and output ending up being half of what was projected, given the fact that Australia is a country with a lot of exports of resources, that may be foretelling in terms of a real slowdown and what China is doing. Although I wouldn't exaggerate China. Sure, it may slow down, but it's going to slow down from, 9 to 8.5% or 8%. That's still substantial growth compared to the United States and Western Europe.
What can one say, Seth? We're perhaps living in an era of mediocre performance. Thanks very much, Seth. Good to have you on the show. Moving on then and looking at currencies now, all the nervousness heading into that Greek PSI, the private sector initiative deal, it's weighing on currencies as well. You've got the US dollar, which has gained ground on Tuesday. Nervousness over the outcome of Greece's private sector bond swap that is leading to the gain in the dollar index, which rose to 78.843. Meanwhile, the euro versus dollar equation has eased, euro dropping to 1.311 to the dollar this morning, down from 1.3226. This is almost a three-week low for the euro. Commodity currencies like the Australian dollar, it's nursing heavy losses for a second straight session in Asia this morning. But let's try and get some analysis going. Dominic Bunnan, Associate Forex Strategy with HSBC, is right now joining in on the phone line from Singapore. Dominic, good morning to you. There's a clutch of Greek pension funds and also some foreign investors who are still holding back on the bond swap deal. Now, yesterday we've had the Greek finance minister saying that the country is ready to activate CSEs, and GDP data from Brazil, from Eurozone, all of that. Net, the forex markets reacting to this glut of bad news.
Yeah, clearly the market's very nervous on what's going to happen with Greece. And I think as we approach the deadline, which will be on Thursday at 9 p.m. European time, then the market is going to get more and more nervous as we approach that, as long as we haven't heard any positive news. I think really the key for us is that, from our perspective, we do still think that bondholders will agree with a large enough percentage to the swap, in which case it will go ahead. And I think really it's going to be a case where it's going to be very volatile in the short term. Risk assets are going to find it very difficult to rally approaching this announcement. But if we do manage to get through this round, then we think risk assets, particularly the euro, could actually start to rally in the medium term. But for sure in the near term, we think definitely that the euro and the risk assets do have a little bit more downside potential.
Dominic, the low-yielding yen, however, it's outperformed versus the dollar. Any thoughts on that?
Sorry, can you repeat that? Was that the yen?
Yes, the yen.
Yeah, no, on the yen, we've had quite a big pullback already in the yen. And I think what we've noted was that really after the BOJ announced its new inflation targets and basically started easing even further, the market started to perceive this as another central bank increasing its QE and therefore putting downward pressure on the currency. But I think we've already had quite a substantial pullback in the yen, with dollar yen trading where it is now above 80. And from our perspective, we're wondering now whether that rally may have actually already run its course. What we've been noticing with some of the other QE currencies is that although the announcement effect is negative for the currencies, a lot of commentators are looking at QE as actually being a source of growth in the future.